In this tutorial, we're going to be looking at moving average crossovers and how we can use them in price. So the first thing I want to point out to you is this chart behind me has a whole series of moving average crossovers. All I've done is apply a whole series of different moving averages that go from fast to slow all the way through to identify and show you what I mean when I say a crossover of a moving average. So you can see where price sort of fans together like here. And when this happens, that's where we're starting to look for those crosses. Now, I'm not suggesting that you use this chart, I'm simply using it as a highlight to show you what we're actually looking at. Now, what is a moving average? Well, the reality of it is just simply a calculation. The calculation that's behind me now is that of a simple moving average. So it is nothing to be too concerned about. You don't need to worry about what that calculation is, but you do need to understand how it works. What actually happens in price is as you develop and move along with your price moving along, then this will plot and calculate a point on a chart for you based off the previous data and what you set it to do. Each time adding a little piece to the line or a moving average. Now, what are the most common ones used? Well, these are actually them. These are the calculations that we've got. We have a simple moving average, which you've already seen. An exponential moving average, also known as an EMA. And a weighted moving average known as a WMA. Now, all of these just calculate the way that the moving average moves along on your chart just a little bit differently. And you do see moving averages in more than just trading charts. They are used commonly in other graphs and data collecting sort of services and statistics as well, but we have had them applied to trading for us to have a look at. Now, as you can see on this chart here, I've just wanted to illustrate how these moving averages and the different types, whether it's a WMA, an EMA, or an SMA, actually vary. So on this chart behind me, you can't actually see price. I've removed it and hidden it from you, but it's all applied to the same chart. They've all got the same settings other than the difference on how they calculate it. And you can see where they move back and forth and that they do vary a bit, but they do move also very similar. Now, the most commonly used one is the EMA, or the exponential moving average, and that's because it gives more validity to the price changes as close to the actual price as really is. As it moves further along, that average weighting gets less and less. So, we're moving on now to have a look at a moving average crossover system. Now, it is a strategy that you can use to apply to your trading today, but I don't want you to focus on the settings or what moving averages that I actually use for it, but more think about how you might be able to use them for yourself to better your own trading. In this instance, I'm using a 5 open and a 5 close moving average. The blue line is applied to the close price with a shift of 1 and a period of 5. And the pink line is set up to be on a 5 period with an exponential setting, and it's also applied to our open. Now, all that means is on our candle, when it's applied to your close price, depending which side the candle is moving from, but if you've got a green bar or an upgoing moving bar, then if it's applied to your open price, it's obviously applied to the lower side of your candle. And the close will be on the top. Now, if it's the opposite way around and it's a short side bar, then it's going to be open price on the top and close on the bottom. And these moving averages are tallying up those open prices and those close prices to formulate and make themselves on the chart for us. Now, what is the principle of this system? You can use it to aid you in picking a direction if you like your candlestick analysis or pattern analysis. It fits in quite well with that sort of trading and scalping, but you can also use it just standalone if you wanted to. Now, it doesn't matter what time frame you use it on. It can be used on any time frame that you like. I personally prefer to use it on a 15-minute and a 1 hour. So I'm using the 1 hour to look for a direction of trading, and then I apply this on a 15-minute chart to give me a narrower field of view. Now, I have made a little bit of a trading plan here for you, with some examples on where you might consider taking an entry. Now, in this, I go through, and you can see the chart on the right-hand side. I show a little bit on where you might be able to look for a potential entry and even an exit. So, the first one to consider is a moving average crossover. And now what I said before in the very first slide that we looked at, where I illustrated what we're actually looking at on the moving averages and that fanning shape, well, the same thing applies here, except we've only got two to look at. So what we're looking at is stuff up here where we can see price. These purple and blue lines are switching sides with one another. Now, when we get one that heads in the direction that we like the look of, we can place a trade at that time. The next way you can look for an entry is if price actually crosses both lines. So if you were trading long before and then price switched to the other side of price and started coming down, then you can start looking for a short trade. And you're ideally going to find this happen after your moving average cross. So keep an eye out looking for that sort of thing as well. Naturally, there's a few different places that can happen. If you're going to exit, price crosses over here, and you end up with a position where you would consider getting out, and you tally your points from this point here over to your entry off the price cross. Now, from there, you can use it in a few different other ways. It is discretional. So, there's no fixed set of rules, but this is just a simple guide for you to get started. You can use pattern recognition and candlestick analysis if you like. It helps you to practice with your candlestick analysis if that's what you want to do or you like doing. It gives you that little bit of direction when you're actually trading it. Now, the next steps to sort of consider are whether you're going to use other indicators, MACDs and such like that. You are free to do so. Oscillators are probably the best things to go with, but nothing is really going to be restrictive on it. And if it helps you with your trading decision, then by all means go ahead and use it. To keep you and just refresh you on what we have covered on this, we've used a 5 open and a 5 close moving average. You can use it in any time frame, but my personal preference is for a 1 hour and then a 15-minute for actually placing the trades. It is discretionary, meaning that you can add anything into it that you feel like you would like to use. Just make sure that it works with your actual trading plan as well. So don't go in there and put in indicators willy-nilly. Try and restrict yourself to possibly only using one extra one. That way you are going to be focusing on building those fundamental skills that you really need for trading through price. Now, the candlestick analysis and pattern recognition is probably the best thing that you can do when you use this sort of strategy. It allows you to actually go through price and trade what you feel works for you. So I'm hoping that today's stuff and what I've covered on it is going to benefit you in the interim period or even just in the short term, whilst you build those technical skills up as you move along, and of course any other skills that you decide to use for your own trading.